It is July 2026, and e-commerce operators are facing an onslaught of platform updates. Fee hikes, policy overhauls, and new AI tools are rolling out at a velocity that breaks traditional operating models. On the surface, the market appears remarkably strong. Amazon's Prime Day just concluded with record-breaking results, driving $26.4 billion in U.S. online spend. However, the ledgers of mid-market sellers tell a different story. Despite the high volume, operators are reporting severe cash flow strain, forced to navigate retail price hikes and renegotiated supplier terms just to keep inventory moving. The disconnect is a result of a massive shift in capital expenditure. Amazon is extracting seller margin to fund its $200 billion AI infrastructure build-out, with leadership framing custom silicon as a fourth durable pillar for the company. To survive the third and fourth quarters, operators must re-baseline their unit economics, restructure their catalogs for machine readability, and distribute risk across a multi-channel data layer. Navigating the barrage of policy and API updates requires a unified operating model. The first pillar is margin mechanics. Amazon is systematically offloading physical and operational friction directly onto the seller's profit and loss statement. The second is agentic discovery. The discovery funnel has transitioned from human-driven keyword search to autonomous AI agent logic. The third is the multi-channel hedge. Diversification has become a structural requirement to offset Amazon's rising platform rents. Mastering the interplay of these three pillars is the mathematical path to profitability in the second half of 2026. This chart shows the margin degradation on a standard Q4 order. We start with a baseline average order value of $46.89. The exact figure recorded during Numerator's Prime Day tracker. First, we apply the October 15th peak FBA surcharge. This removes 32 cents from every unit that leaves a fulfillment center. Then, we subtract the 3.5% fuel and logistics fee added earlier this year. Finally, we factor in the FBA storage overhaul. Q4 standard size storage has climbed to $2.40 per cubic foot, while the low inventory penalty penalizes any stock levels that fall under 28 days of cover. Running 2026 deals on 2025 fee assumptions ensures that those units sell at a loss during the Q4 peak. Amazon is also extracting value by forcing operational and physical compliance costs back onto third-party sellers. As of July 1st, Amazon ended FBA prep and labeling services in Canada. Sellers must now ensure every unit is prepped and labeled before it arrives, adding new labor and logistics steps to the inbound process. On the merchant-fulfilled side, a new September 30 rule requires FBM sellers to maintain a 90% business hour delivery rate. Failing to hit this mark results in deactivation for Amazon business buyers. Additionally, a new 75-character title limit is being enforced marketplace-wide. Amazon is now using AI models to automatically truncate and rewrite non-compliant titles without a seller review step. The Amazon architecture is shifting the capital and labor costs of marketplace compliance directly onto the seller's P&L. Product discovery is moving away from the traditional keyword search model and toward a system defined by autonomous AI buyers. This diagram shows the transition. On the left is the legacy A9 funnel, where keyword rankings drive clicks. On the right, an AI agent filters structured attributes and account history to recommend a single high-probability purchase. Amazon is centralizing this through its Agent Core infrastructure, merging the Rufus chat assistant into a unified Alexa for shopping experience that lives inside the main search bar. This isn't a forecast, it is a live market shift. Adobe data shows that traffic from generative AI sources to retail sites has already increased 103% year over year. Amazon is enforcing this shift through the listing quality dashboard. Organic rank and buy box eligibility are now being actively punished for any ASIN with backend attribute completeness below 65%. Human-facing copywriting is rapidly losing its influence. Providing exhaustive backend data for machine readers is the new ranking algorithm. The response to Amazon's margin squeeze is to distribute transaction volume across parallel infrastructures. The competitive landscape is maturing to capture the third-party margin Amazon is shedding. Walmart's e-commerce GMV has crossed $150 billion, supported by the integration of Google Gemini AI into their checkout and first-party data pipes into Google DV360. TikTok Shop US reached $30 billion in GMV in the first half of 2026, becoming a dominant force in beauty, supplements, and apparel. Simultaneously, Shopify has opened native B2B net terms to all paid plans, giving smaller sellers access to enterprise-grade receivables financing. Multi-channel expansion is a structural requirement to offset Amazon's rising platform rents. Managing tightening margins, AI agents, and multi-channel routing requires a technological capability that legacy spreadsheets cannot provide. Updates like TikTok's Open Commerce API and Shopify's AI toolkits prioritize centralized data management over individual channel operations. When data is centralized, AI agents can optimize pricing, inventory, and listing attributes across the entire ecosystem in real time. The competitive advantage has moved from those who attempt to hack algorithms to those who maintain a clean, centralized data architecture. The playbook for the second half of 2026 relies on this data foundation. First, calculate per SKU contribution margin daily, moving away from monthly aggregate reporting that hides leakage. Second, format your entire product catalog for machine readability to capture agent-driven purchases. Third, distribute your operational risk across maturing platforms like Walmart and TikTok Shop. Amazon is now a high-friction, lower-margin environment by design. Surviving the agentic era requires flawless operational physics.